All right. Welcome to another break into today's bond trade. Because you have a mortgage or you're about to get one, Wall Street is trading your money before you ever sign the paperwork. And this week gave us one hell of a lesson in how that trade actually works. Now, Monday, mortgage-backed securities rallied. Why? Because oil dropped. Optimism around Iran increased, and Wall Street immediately started pricing less future inflation. Tuesday, oil fell another 5%, helps increase for progress involving Iran and Strait of Hormuz. So that is something that's going to cause the bond to rally again. MBS gets improved. Mortgage rates get a little bit better to their lowest level in about 2 weeks. Then you get to Wednesday. The market basically took a breath. Oil stabilized. Economic data didn't give bond traders much reason to change their trades, so it kind of held tight. Then Thursday, the story changed. Oil bounced. The headlines became less friendly. Massive corporate bond offering dumped additional debt supply into the market. Bonds weakened, MBS gives some grounds back, and lenders start repricing a bit. Now, we're going to look at the charts here in a bit, but the 30-year UMBS was sitting around 99.58 this morning, testing other levels, but we bounced. We're still inside that larger downward channel that I've been showing. So it's important to know where these resistance and where these strengths are, where our support's going to be. And bottom of our channel is our support, top of our channel is going to be our resistance, and we got little lines within it that we'll show on the chart. Now, I'm calling it what it is, what it really is. It's a battle over the price of money. And today we get another piece of that battle, the jobs report. Wall Street is expecting roughly 80,000 new jobs. If employment comes in substantially weaker, bond traders could increase their expectations for easier Fed policy. That's potentially good news for MBS. If employment comes in substantially stronger, the market may decide the Fed has even less reason to ease, and that is potentially bad for mortgage-backed securities. There must be a bigger story developing somewhere, and I want that real estate investor to understand that things out there in the news space is what's going to drive this, not what the Fed does, and definitely not what the treasuries do. There's a lot of other things that drive this around. So Jamie Dimon, we all know who he is. He raised an interesting warning this week. Look at the amount of capital the world is demanding right now. AI, data centers, power generating, infrastructure, defense, government borrowing. Everybody is competing for capital. When everybody wants money at the same time, the money demands a higher return. That's basic supply and demand. So you as a mortgage person or a investor wanting to get a loan saying, hey, I demand cheaper money. And then you have other people demanding cheaper money, but they're demanding on a bigger scale than your $100,000, $200,000 loan. There might be a greater attraction over there because they can park it into one spot and get a different yield that might be better than what you're offering. So that supply and demand could be pushing us one way or another, depending on where the bond traders want to go. That's exactly what I've been trying to teach you about mortgages. Your mortgage is a bond trade. The investor buying your mortgage is asking, what return do I require to give up my capital to you for 30 years? If they're worried about inflation destroying the purchasing power of those future payments, they're going to demand more yield. MBS prices are going to fall, mortgage rates are going to rise, and you're standing on the other side of that exact same trade. Wall Street is buying your future payments. You're buying control of the asset today. That's why I argue the mortgage can be the greatest asset in the real estate transaction, period. You put a fraction of your property's value into the deal. The mortgage provides the rest of the capital. Your tenant pays the rent. That income services the mortgage. Your equity increases. You're controlling the entire asset while only having a fraction of its value of your money on the table. Meanwhile, there's another force working in the background, inflation. Inflation doesn't only make groceries and gasoline more expensive, it reduces the purchasing power of the dollars you're contractually obligated to pay. That's an absolutely beautiful thing. Part of that part of the long-term fixed rate financing stays the same. The dollar changes. Your principal and interest payment doesn't. And you get the optionality that if the rates go higher, you get to stay in it. If the rates go lower, you get the ability to refinance. Think about that. Don't just refinance because the rate went down. Don't do that just to brag about, hey, I have a better interest rate. That's a fool's errand chasing interest rates. Refinance when the economics allow you to access capital and put that capital into another productive asset. Now you've got another asset helping you acquire another, which helps acquire another, and you're compounding wealth with somebody else's money. When you get into it and you pull the money out of your asset, that property, to buy two more properties, you literally bought two more properties with somebody else's money you took out of another property. It basically bred into two other properties. Now you got 3 for 1, and you have no money of yours tied up in it. What's your return? It's almost impossible to calculate. So when you're looking at what's going on with the interest rates, you're sitting around for this magical interest rate to happen, you are actually waiting for somebody else to make your money. If you're waiting for the rates to get low enough for a property work, you're not buying the right property. You need to ask, does this asset work in today's cost of capital? Because if you need some imaginary future rate to make the deal work, it's not a freaking deal. You need to follow the money. You need to also understand the bond trade, understanding what Wall Street is demanding for its capital, and then decide what that capital allows you to control. So let's go into the bonds and let's take a look so I can share with you what has happened this week. And I'm actually going to get kind of ugly with it. It's going to look pretty messy. And so let's take a look here. You've got all the way back to a year ago. I'm showing you a snapshot of the entire year. You've got Fed rate cut, Fed rate cut, Fed rate cut. And we can see what happened after the Fed rate cut, right? See, we see negative movement in the market because that creates inflation. Only one time did the Fed rate cut actually turn around and push us into positive direction. A lot of it had to do with them talking about quantitative easing. Then you get here, this day, this is when Trump was urging the GSE, Fannie and Freddie, put $200 billion in the market. Then a couple of days later, like, oh, we still haven't figured out how we're going to do it. So it fell back below this. This line here represents when they are going to do quantitative easing. When they talk about it, it gets up in here, up in this range. When they start putting together a plan, it goes above this range. It never came to fruition. So the plan never went to work. And then you get the bombs dropping in Iran. Bam, we see this falls off completely, right? Have another Fed meeting. They kept the rates the same. Still was some negative movement to the market. Then you have another Fed meeting, kept the rates the same. Fed meeting, kept the rates the same. Fed meeting, kept the rates the same. So we're in this downward channel. This is where we're trading. This is what we're seeing. We have all these marks that I've seen in the past be forms of resistance or support, depending upon which side of the line you're on. So now we're on the side of resistance. So we're going to be seeing this until we get up to the top of it. We're going to be trading downward for the foreseeable future. This is going to be our huge floor. These are our monster ceiling, because this is our quantitative easing ceiling from back in 2008. So remember, you're buying control of an asset, regardless of what this rate is. Who gives a shit what the rate is? Control the asset, or somebody else gets it. Use the system. Understand the system. You need to quit jerking off and getting a trade.